Hey, looks like we're live. So today is February 28th, 2021, and we'll be going over some stocks that I've seen on screeners and ones that are making bases. We're also going to talk about bonds, and we're going to talk about Tesla and ARK, and whatever else that we think is interesting. So I was looking at a screener here from FinViz, and what I did is I set it to optionable and shortable, float short over 30%. And I don't know where this data comes from necessarily. It may not agree with some of the data that we're seeing in other places, but nevertheless, it's a helpful screen. One of the stocks that came up on here I was surprised about was just scrolling through these. A lot of these have had big pops already, like GME, AMC. But this one, Oots, when I looked into this, I was really impressed with what I saw. So I've been digging around on Oots a little bit. And the short percent of float on Yahoo Finance shows 5.44%. So nowhere near that 30% plus that we see on the FinViz screener. So I'm not sure why those disagree. But when I look at the chart for Oots, that looks really good to me. So this is one that I'm watching pretty close. Not exactly sure how I'm gonna or what I'm gonna do with it, or if I'm even gonna take a position here. But it looks like it's just stair stepping higher, and we haven't seen huge volume come into it yet, except at the beginning of the move. So this is a weekly chart right now, and there was a huge breakout at around 11 or $12, and real nice base that broke out from, and it's now about twice as high, so about 100% higher. And what they say is, if you want to find a stock that's going to double, look at the stocks that have already doubled, because these are ones that it's likely that they'll double again. So this is still kind of early enough in the move for me to still be interested in this. A lot of stocks that have been running for this long, they're up way more. They've been trending higher longer. They're not really emerging trends. This one still looks like it could get real active. It's not super active right now. The weekly volume, we see 2.5 million shares. The options volume is not very high. I see just under 2,000 contracts per day, which is really low. Another one I'm looking at is iRobot, and I heard that they had a glitch. They rolled out a software update that made some Roombas uh, lose their uh, tracks or whatever, and start acting like not intelligent. I don't know that that's really going to hurt the stock, because a lot of those software updates they can just quickly fix by pushing out another update. So I don't think that's necessarily going to hurt iRobot, but I don't know. In any case, so let's look at Oots just a little bit more. Um, Zooming out on this, it looks like it hasn't been around that long, but it's not a new company. This is the snack company. Like they do like Oots pretzels. That's the only thing I knew of from Oots brands was their pretzels. But if I go to profile, uh, we see we see Oots brands manufactures, markets, and distributes snacking products in the United States. So this is the Oots pretzels brand. They've got some other things, like I've heard of this one, Boulder Canyon. I think they have some pretty good potato chips. This is not an exciting sector. It's like a consumer staples kind of thing. So yeah, consumer defensive is the sector. Packaged foods. I'm not sure why this would be a really hot thing, but it's hard to argue with a chart that looks like this. So I'm interested in watching this. What I'm going to be looking for is some real tight closes. Maybe like a short-term bottoming pattern like this near the moving averages, and you can see there's wicks on the bottom of this daily chart, but there's also wicks on the top. So that tells me it wants to be in a price range for a little while. So we'll watch it and see if it sets up any kind of a buying opportunity. Like this dip right here looked like it would have been a comfortable place to get in, but it didn't even really go anywhere off of that. It's just kind of gone sideways. So if you're trading options on it, you're burning up time. So what I'll be watching for is either some kind of a base to form or a breakout to new highs. But I'd like to see that breakout happen with big volume. So it hasn't had much volume in it lately. So let's just look at the options on UTS real quick, and then I want to flip over to rates. So we'll look at bonds next after UTS. So not a whole lot of open interest here, and also it's only got monthly options. So I think one thing I looked at doing on this, yeah, you can see the combo I built up here is, I'll just rebuild the combo. What it is, I started with April, and I just got, for each leg of the combo, I just went to each month and added the furthest out of the money contract as a combo. And so if we look at, we can add the March one too. It's not a 35 strike in March. The other ones are all 35 strikes. So if we look at this as a combo, it's got a bid-ask spread that is fairly wide, but the return profile here, like if UTS rockets higher, this combo, and it doesn't even have to happen right away. So if I take the March one out, we can fast forward out to April and look, but essentially, like, it's as soon as it starts moving up around to around 30, if it gets there somewhat quickly, this combo for not a whole lot of money makes huge money. So there's pretty low implied volatility here for UTS, and so if it were to take off, and it's hard to know what short percent of float numbers to believe, because Yahoo's showing a very different picture than FinViz. So I'm not sure if short covering is going to be much of a factor here on this one, but I do like a combo kind of like this, where it's it has a lot of time. Let's take that strike off the March one and take a look at it. So it has a break-even price of 27.5 on this. And what I like about that is that's just right at the new high. So that's pretty nice. I mean, it looks like it could easily get to that break-even level. If we look at it all the way out to the nearest expiration, you can see that if it doesn't go anywhere, if the price doesn't go anywhere in 47 days, which is, I guess, like a month and a half of trading, then it loses a little bit of money as those first expirations start rolling off. I don't know that it has 100% move in it in a year, but it might. It probably could rise 60%. And so if it does, say you paid $500 a combo on this, you know, if it rises 60%, that's pretty big returns. So I don't know that I would try to buy put protection on this. It just doesn't really strike me as something that would be beneficial. So that's my analysis on UTS and maybe some ways to put a trade on here. And ideally, if we got a down swing to this 50-day moving average, that's probably a better time to put this position on. So I'll be watching if it falls to support and the volume is low and it looks good, then I might start to put on a position similar to this one in UTS. Similarly, if it looks like it's not even going to fall that far and starts to hook back up, I might start to get in and then add on the breakout. Of course, I'd pay up and it would raise the break-even price. But I think this stock hasn't really come alive yet. It's starting to run, and it could get interesting. This is the kind of stock that, if given enough time, the price moves racing higher will bring interest to the stock. So, okay. Anyway, that's what I'm looking at with UTS. Let's now switch up to look at bonds. I had Chris Sell the Fucking Rip Trader on the show on Thursday with me, and he was talking about the dollar strength. He had been talking about it all week, actually, and on I think it was Thursday evening's show, he called out that TLT was looking really strong. We were looking at this wick right here on the Thursday bar, and if you zoom in on it and look at 30-minute bars, you'll see that it was making it looks like it was putting the brakes on the drop, and it was looking really strong. And looking at this 30-minute chart, it looks fantastic. I mean, it may not keep on screaming higher for now, but it looks like the drop in TLT is at least over in the short term. So what I did is as soon as it kind of made this higher this higher low on Friday around lunchtime, I went in and put on a back spread in TLT, and I'll show what that position looks like. I was looking at shorter term trades, and I didn't like how expensive it looked. So what I ended up going with was the April expiration. So let's look at the position. I put it on as a back spread because if TLT is not done going down, I want to be able to adjust my position lower. So say that this is just some short covering, and that it continues to fall lower. And that's a reasonable concern because look at how long it's been going down. So this weekly bar is the first bar to look like this for a long time on TLT. It was as high as 177 during the March lockdown crash of 2020. So if we're coming into market turmoil in the short term, it could outweigh the negative effects of a stimulus. I mean, people saw this new stimulus bill coming a long time ago and started selling off TLT ahead of it. And I think this may be one of those sell the rumor and buy the news kind of things with TLT when it comes to the stimulus bill. And also with turmoil coming into the market, and we're going to talk about ARK and Tesla a little later. So those could be a factor. There's a whole lot of factors coming together right now why the market may de-risk. And if it does, TLT is going to benefit. Probably will have seen the end of the rising rates on the long bond in the short term or intermediate term, depending on your time frame. So let's look at this back spread that I put on, and the reason to use a back spread instead of just calls is, again, if the price drops, then I can just roll. I can use the roll tool and just roll down on strikes, basically for free or for really small cost. I'll just pay a little bit of time premium maybe if it drops pretty quickly. So the time frame I ended up going with is April expiration, the monthly expiration. And the position that I built was I sold the 135. I bought the 141, which was at the money at the time. And then I used this credit. You can see right here, there's a credit of around, say, $4.50. And I bought 3 of these 147s. And when I put this on, I ended up paying, I think, a credit of 1 cent or something for this trade. So it did close at the high. So it looks like the ask is $4.26. So it did move in my favor after I put it on. Zooming in again on the 30-minute chart, you can see that this big push at the end of the day, in the final hour of trading, it moved this trade into a profit, at least in the short term. So the way that these back spreads work is, hang on, that's way the wrong range. Let's look at this range. So we're looking at a range of 30% moves. So when I put it on, remember, it wasn't $4 ask. It was the ask was under $1. I think it was like minus 50 cents bid plus 50 cents ask or something like that. And so when this shows minus $400, really what it's showing is any profit that I would have had is disappearing. So it doesn't matter how much lower it goes. I'm not digging in. I'm not losing the margin I put up. I'm just losing profits. But if we factor in some calendar time, like say it takes some time to drop, then it does lose a little bit more if TLT drops a little bit, like it cuts into some of the margin. So it's $600 per combo of margin required for this. But you can see you're getting a lot of juice here for that $600 margin. So if TLT is up 20% by April, let's go all the way out to April. So at expiration, a 20% rise in TLT takes it to about 170. And if there's some market turmoil, I think 170 is probably like a reasonable target. If we zoom out and look at the weekly chart, it's down so much, and so add to that the fact that, like, you know, there may be some natural rebound on this, and if you add in the possibility of some market turmoil, it could overshoot 170, but I think 170 is a reasonable target. If it does overshoot, you know, that's fantastic. But if it's this target of around 170, then that's a 10x return on the margin that was put up. So that's pretty good. And that would, so this is, I've been talking about long TLT and short HYG when the timing is right for a while. And I already put on the HYG shorts, and I just now have legged into the TLT longs. And this is the way that I'm playing TLT from the long side. The way I'm playing HYG on the short side is different. Let's just quickly recap that. Let me show a ratio of TLT colon, let's put HYG in the numerator, put TLT in the denominator. So, and let's zoom out. Let's take a long-term view. So these assets are competing with each other for capital. And so they basically oscillate. And so now we've seen that it's kind of on the higher side here. And if we get a swing back down, that's what you'd expect to see in a down market. So if you look at, like, the place where this was down the most was on this chart was in March of 2020 during the lockdown crash. So these other periods where this ratio is down, they were hard times for the market as well. So if people remember the Christmas rebound of 2018, at the end of 2018, the market started tanking in December. I think it might have been as early as October. The market started tanking. And it bottomed at Christmas, like almost to the day. And so you can see that when the market drops, that this ratio tends to fall. And let's zoom out too, and I'll try and get the 2008 financial crisis drop on there. So you could see it on here. Like, it's in 2008 as the market was crashing. This ratio was falling also. And if you notice that it made a higher low in March of 2009 than it did at the October lows. So the S&P kept going lower, but this ratio made a divergence and didn't make new lows. So anyway, I think it looks set to maybe reverse here to me. Don't pay too much attention to these gaps. I don't know that they necessarily mean a whole lot on a ratio chart, because it's a ratio chart. So you can't do exactly the same kind of technical analysis on it that you might for looking at gaps on stock charts. So anyway, So now I've legged in on both sides. I've got the HYG short and I have the TLT long. The HYG short that I have on, let's just quickly look at it because some people may not have seen that on previous shows. So let's go over here. Do I have it built out? No. So what I did with this one is I have the March expiration, and on the put side, what I have is the 87, 85, 83, and 81 as a combo. And it looks like this. When I got this, it was, I think my average price is a little over $1 for this. So this is working out well so far. If the VIX fades, then this is also going to fade. But I mean, I don't know. VIX looks like it could be ready to rip higher. And if it does, then this thing could really fly. We can look at the charts of these if we want. So add to quote panel. Let's bring up a chart for the HYG trade. Yeah, so you can see in here I was accumulating it at around $1, and it's ripped higher. Both of these combos have pretty high time decay. So when the trade's working, it's great. But I mean, you know, this is still not at the break-even price for me. My break-even price is around 86. So I need HYG to fall further pretty quickly because there's only, I've only got a few weeks until March expiration. So I won't be buying more of this particular combo, but what I will be looking at doing is buying similar combos with more duration on them. So I mean, for now, I have the exposure I want. But if I'm going to add, I'm going to do a similar trade with further out to go. So hang on, let me check my phone here. Yeah, that's nothing. I don't know what that alert is. Okay, so we've talked about TLT and HYG, and I think next up I wanted to talk about ARK and Tesla. So first, let's look at ARK. So on a long-term chart, this thing is up a lot. However, the businesses that ARK is invested in, they're now very expensive. And so people who are investing in those companies early on in the move, or early in the trend, I should say, they're reaping a much higher rate of return. And new investors coming in now are they're paying up for these businesses, and their forward returns are unlikely to be as good. So something else I want to call out is the volume. Look at the volume here. I mean, this is, let's now switch to a weekly. And so ARK had its biggest volume week ever, and it was a down week. It took it down to the 21-day exponential moving average support, or I'm sorry, 21-week moving average support level. So I don't know that that's a real strong level. It's got some support, but I mean, really, this thing's been trading in an air pocket for the last 6 months. So I mean, it's loaded up with holdings. Let's look at the ARK holdings, ARKK. And I know that it changes a lot, and this data might be a little outdated on Yahoo. You can go in and look. They publish their holdings on the website. But Tesla, Roku, TDoc, Square, CRISPR, Invitea Corp, Proto Labs, Baidu, Zillow, and Spotify are the top 10 holdings for ARK. There are lots of other smaller companies that ARK has. And so some of the talk on Twitter right now is that there could be a squeeze put on ARK where outflows force selling. And as ARK rotates out of things like Apple and Amazon and into things that are down, like Tesla, what it can do is it can exacerbate these moves. So I wanted to talk through an example of how this could work, but when you're rebalancing continuously, then some of the problems you could run into is you're giving up some of the benefits of diversification if you're continuously rebalancing. And so just as a simple thought experiment, imagine that we have two companies, company A and company B, and we have half of our money in each of these two companies. If company B goes bust, then we should still have half of our money, right? Because we will have only lost half our capital because we have half of our money in company A. However, that's not the case if when B goes down and we sell off some of company A and rebalance that capital into company B. Well, if B goes bust, goes to zero, and we are continuously liquidating our holdings of company A to add it to company B to sort of bring it back up to 50-50. Well, what will happen is, depending on, I mean, now it's path dependent, but in theory, you could be left with very little capital left. Like if B goes all the way to zero, then you might only have 10% of your original money left in A because you've been selling A off and buying B, but B keeps on going down. And so, you know, these kinds of, the stage is set for these kind of scenario. When stocks get really elevated, like what's happening with the NASDAQ, so it's not just ARK that has huge volume right now. If we look over at the NASDAQ 100, QQQ, I mean, it's not the biggest volume, but it's pretty big volume, and it was down 5% last week. ARK was down 14% last week, so that's some turbulence. So, and what I think I retweeted some people who were commenting that, hey, Cathie Wood is selling Amazon and selling some Apple and using those proceeds to buy more Tesla as Tesla goes down. So Tesla also has got some support at the 21-week moving average. I don't know how well we can expect this level to hold. Tesla to me hasn't really looked healthy for a while. Ever since it came up and had this like false start at 900 price, it should have broke out there. If we zoom way in, I've been calling this out on the show several times. If we zoom way in and look at that false breakout, is it still visible on let me go to an hourly bars. There it is. So here's this false breakout where it went up there. It looked like it was going to run, and it faded right back into the range. And then it's just been kind of falling apart. It's only just now on Friday acted like it found some support, but I mean, this was a rough week for Tesla. So Elon Musk was in the news, and I don't know that it was really a very positive press. And I also don't know how much credence to put into it, but people were putting screenshots of court cases up where Elon Musk was being named, not as a defendant in the case necessarily, but maybe as somehow his name appeared in the case. That's what it showed in the screenshots. I mean, I don't, it's not my data, it's not my information. I don't really know a whole lot about it other than we can certainly at least put it into the file it in the rumor mill category. And how badly that hurts Tesla, I don't know. But here's what I can say is if we look at Tesla, oops, that's not the right symbol. I was looking in here earlier, and their earnings per share 12 trailing months. So for the last 12 months, it was 64 cents per share earnings. And if we go over and look at the statistics, let's look at how many shares are outstanding. It's a billion shares. So 65 cents of earnings. That's what, like $650 million it earned in the 12 trailing months, and they have purchased $1.5 billion of Bitcoin. If we look at their cash, the total debt is 13 billion. Total cash is 19 billion. So I mean, it's just a portion of their cash. But nevertheless, if you compare the size of that Bitcoin purchase to their earnings, the price moves on Bitcoin. I'm not sure what their average price is, but the price movement on Bitcoin, it's gonna move their earnings. And so this earnings number it's an accounting number, and the way that they have to do accounting for the Bitcoin, I've heard that they don't get to mark gains until they sell it, but they get to like mark losses as it falls, and then if it rises back up to their average price or their basis, then they can mark it up, but they can't mark it up above their average price until they sell. Is something I read, and again, I don't know if that's true or not, but the point is that $1.5 billion of Bitcoin is going to be a factor for Tesla. So if we see Bitcoin and cryptocurrencies going down, and if we look over here at Riot blockchain was down 38% last week, and so that's a lot. There's turbulence going on in this space. The point of where I'm going with this is all connected. It's connected up with what's happening with bonds. It's connected up with what's happening in ARK, and the theory is that as turbulence comes in here, it can make ARK, it could cause outflows from ARK, and there are people. I've retweeted some of this, so there's more details in my retweets, but outflows in ARK could force them to sell down their portfolio, and some of the names are they're getting more and more concentrated into their least liquid names, and for every liquidation, like this is kind of how it goes. They sell off the liquid stuff first when they have redemptions, and also we see them rebalancing from liquid things into illiquid things. And so there's the recipe for, I don't know if I want to call it a perfect storm, but a big storm to happen to ARK. And so I was comparing put protection in ARK against put protection in Tesla, and looking at, well, where do you get better bang for the buck? And it looked like you could, the Tesla puts were, let's see here. How do I put this? Well, here, let's just go in and actually reproduce that research I was looking at this morning. So I'll put Tesla in here, and let me put ARK in here. And what I want to simulate is a 20% drop. So Tesla right now is let's say $670. So 670 times 670 times 0.8, 536. So let's look at a put spread for March expiration that that essentially has a range from at the money till a 20% drop of around 536. And let's look at what the statistics on that are. So March expiration. Here we go, and we're going to buy. We're going to do a bear put spread. We're going to buy at the money at 670, and we're going to cap it at let's just call it 540. So I'm kind of rounding here. All right, now let's take a look. So in here, what we find is that the return to risk is 2.64. So let me now do a similar thing for ARK. And I think what we'll find is that for a 20% drop, the puts are going to be, they're going to have a higher return to risk in ARK. So this return to risk number will be bigger in ARK is my guess. Meaning that the puts are cheaper because people think that it's more likely for Tesla to fall 20% than it is for ARK to fall 20%. I don't know that that's actually true. So we'll talk about that in a second, but let's carry out the rest of this study. So ARK 20% drop would be 130 times 0.8, so 104. So let's see what we can do here. So same calendar, we're going to March expiration. We're going to buy an at the money put on a bear put spread, and we're going to sell at 104. So I mean, we don't even really get anything for selling at 104. So this is not a spread that I would put on. But the point is, okay, so it's only maybe slightly higher return to risk. So the market is saying that it's actually like similar likelihood for ARK. However, I wouldn't put this trade on. Like the way I see it going is if ARK is hammered by outflows, then here's what I expect to have happen is it may get halted. I think looking at what happened with XIV is probably a pretty good model for what to expect. Like in after hours, there's maybe an earnings report for one of the companies and something like that. Some kind of a condition that happens outside normal market hours when a period where it's super illiquid, and you see ARKK down a very large percentage because something happened with one of their holdings, or it just trades lower. They could push it real far outside of normal market hours, and I don't know that there is a circuit breaker that's going to kick in outside of normal trading hours. And so with XIV, I mean, that thing was down. I mean, it was unbelievable. It was down like 80% or something. And so I'm not suggesting that ARK would be down 80%, but you could, I mean, consider the possibility that ARK could go down 20 or 30% in after hours or in pre-market, and it just halts. And so I think probably what I would expect is I would expect ARK to halt, and you'd have to start watching at that point. We're kind of like wargaming this out. You'd have to watch ARK's holdings at that point and see how those were trading. And I would expect that probably all those names would be down. And what would be happening is ARK would be trying to use sales proceeds to meet the redemptions. I mean, they would basically have to do that. And then when it reopens, it could reopen, I mean, if it reopens, it could reopen a whole lot lower. Like ARK could fall way more than the constituents, you know, if you look at the constituents as a basket, because, you know, if they're forced to liquidate assets at fire sale prices, well, when those assets rebound, you know, they're not in them anymore. And so ARK could lose a lot more than the basket of its holdings as a portfolio. So, I mean, that's a risk people need to be aware of. And so if that does happen, then, you know, ARK could just keep dropping. It could be in, you know, people call it a doom loop or a death spiral. These are possibilities. And so I think the way that I might play this is if you look here, look at this, 75, you know, for each week, you know, there are really, really cheap options here that are put options that are out of the money. I mean, this thing, 80 put for 10 cents, like, market makers don't care about this. They're not worried about, they think that they can delta hedge this thing all the way down. And they're not worried about, you know, selling you an 80 put because they don't think that it could open up, 30%, 40% lower than where it is. Now, I understand that this is way out of the money, but I'm talking about the scenario here where ARK opens up at like 20% of the value when it does reopen for trading at 20% of the value of what it already had. So what has happened here with ARK is essentially like there's a whole bunch of retail money that is flowed into ARK, and it's now concentrated. And the opportunities that they have at these higher price levels, it's a whole different picture than when ARK was in the $30 to $60 range. And so any kind of turbulence could set off something like this. And so this is it's a wide range bar too. So if we look at the range of last week's bar, there's a high of 150, let's just call it 150, and a low of 126. That is a 24 point range, so 24, 25 point range. But the weekly ATR is 11. So, this ATR, it's rising. This is rising. Well, as it gets turbulent like this, it can create the scenario where institutions are cause the outflow because they don't want their money in volatile things. When it was just trending up and just being a momentum, acting like a momentum stock, trending higher, it's a comfortable ride, and institutions are okay with that. But they have bills to pay, and when their holdings get volatile, they actually will rotate money away from volatile things. Institutions do. So what I'm going to be doing with ARK is I'm going to be essentially buying tail risk on it. And one way to do that is right now it's 130, and so I might buy a combo that looks like this. And so, I don't know how low it's going to go. But if you look at this is an out of the money combo. We can add one more leg in. Let's add the 110. And so, I want to bid on this together as a combo because I'm more likely to get the bid ask split if I'm ordering as a combo. And if we look at the profile for this combo, the thing I like about these is if you're right and it really crashes, then you stand to make a lot. Say that it, imagine that scenario where I talked about, it gets hammered overnight and opens up at 20 to 25% of the value of what it had. Well, in that case, on this combo, what's the ask here? So $200 per combo of capital put in, and if it opens all the way down there, like what I think might be possible, this is just like crazy percentage returns. And so you can't go big on this because you don't know when the timing of it's going to be. But I will suggest that it's more likely to get wrecked when it's down off the highs substantially than it is when it's trading near these all-time highs, because it's not under pressure. There's no distress there. So and to quote Kathy, she says there will be fear. Well, there's not fear when it's trading up near new all-time highs or near new 52-week highs. It's when the market is down like this that it's vulnerable. So, I don't know where it would open, but just consider the break even here on this combo is 108. So, if you look at the range it had last week, where, look, it closed minus 22 points. Well, 22 points lower from 130 is 108. So, I mean, that kind of gets me to my break even. If it has another bad week, if I'm buying this. So, and really, I'm trying to, the scenario where we make money on this would be, if it opens way down, and so it's certainly possible. Markets can do these things, and so this to me it looks like a tail risk opportunity. So this is the kind of combo that I'm going to be looking at. And if you really want to be cheap, then knock this 110 off of there. It makes the break even a lot lower when you do it like this, but it's also a lot cheaper to get it. So this is hardly anything. I mean, everybody trading has $135 in their account. No, I mean, if that was all you had, you probably would want to not put it in something that could evaporate in a week or less. But it's cheap tail risk. So if you're trying to hedge a portfolio, this is maybe something to consider doing. I think that puts on ARK right now are probably this may be one of the cheaper ways to get really good protection. So that's really what I wanted to cover in this. Let's see. There were some other stocks that somebody put out. It was an electric vehicle stock. I'm really kind of tired of the whole electric vehicle theme. So probably let's talk about that. I mean, it's so overextended, I think is probably the word I'm looking for. Okay, here's the symbol. It's and let me tell you who tweeted this out too. In fact, I'll just put the tweet up here so you can see who tweeted this out. Hang on one second. I'll put it on the screen. Okay. So this guy, Great Stock Picks, day trader. That's really funny. So he tweeted out this chart. I agree. It looks great. Cup and handle breakout. Huge volume coming in. The volume patterns look great. $ FSR. This is Fisker. He says is one of the strongest stocks out there. And so, if I'm looking at, well, I could put money in Tesla or I could put money in Fisker. Well, take a look at the Fisker chart, FSR. I mean, he's right. Like this is an emerging trend in Fisker. It looks strong. This is a much better place to put new money to work. On the daily chart, looks fantastic. It's up 32% on Friday. So, to get in with, it does have weekly options. I took a look. Let's take a look at FSR. So probably with Fisker, I'd be looking to do a swoosh position, and it might be really expensive right now after this big pop. So what I may do is wait for 2 or 3 inside days, and or maybe for it to fall back to a 5-day moving average or something like that, 5-day or 8 or 9-day EMA, and once it's fallen back and kind of consolidated, that's the options that I'm trying to buy are going to be a lot cheaper and accessible. So, or at least that's what I expect. Now it may not. I mean, it could just keep on running, but I don't like to chase. So I mean, my feeling is this: like it wasn't on my radar when I should have bought it. So I'm not going to buy it yet. I'm going to let it come to me. So let's look at a swoosh position on Fisker. The way I like to do these on these, like, I don't know, $20, $30 stocks or 40, 50, 60, whatever. The way that I'm designing these kind of positions is to try to minimize the commission as a percentage of the trade and the bid-ask spread. So I'm trying to not have a million contracts because or thousands of contracts or hundreds of contracts, whatever is big relative for you. It's so expensive to move in and out of a large quantity of contracts, and so Structuring positions like this solves that problem. So what I'm looking at is 3 to 6 months of time. So let's look at August. And to build the swoosh position, you'd buy an at-the-money call. And so in this case, probably it looks like 30 would be the call to buy. And, oops, sorry, we're building a combo here. And then what we're going to do is we're going to buy some short-dated protection. And so 3 to 4 weeks to go. We want to roll our short-dated protection with at least 2 weeks to go, if at all possible. However, the price of the put that we buy, it should be slightly out of the money, and it should not exceed 1/3 of the price of the call. So looking out here, 10% lower is around 26. Yeah, 26, 27. And so probably this would be the call to, or I'm sorry, the put to buy right here is the 26 put. And ideally, you know, this would be shifted slightly lower. We would be a little bit more at the money. So a few other concepts that have gone into this kind of a combo. People don't write about this. It's not like a widely known combo. But here's what's nice about it is the call that we're buying doesn't have a whole lot of time decay because it's essentially at the money. And the put we're buying is an inexpensive leg of the trade. And the idea here is when we roll this, like if the stock doesn't go anywhere, then yeah, we get hurt. We're paying to roll the put. But if the stock goes anywhere, then now we're at an advantage. So when we look here, the reason it's called a swoosh position is because it looks like a Nike swoosh symbol when you look at it on the options simulator. So let me zoom in. This is just, it's too wild. So, okay. Maybe zoom in more. Here we go. So let's look out on the calendar about a week. So that put is burning up pretty fast. Like if Fisker doesn't go anywhere, and this is what I'm talking about. Like these options are just a little too expensive right now for me to want to do this. Like I would rather wait and let the options calm down, because if it goes nowhere, then even if it goes up 10%, look, I mean, it's the position's at a loss a week later when I have to roll. So I don't like how expensive these are. But once it calms down, this would be the kind of position that I would want to build. And ideally, you should be able to see the swoosh on a 30% simulation. You're not really seeing that here because the options are so expensive. You have to zoom out to see the swoosh, which is a sign that, hey, these options are super expensive. The implied volatility is 155. It's so high. And I don't know if that's because they've got an upcoming earnings announcement or something like that. A lot of times that's what it'll be is, I'm trying to buy the put between now and when there's an earnings announcement. So let's take a look at that. If we could find that out, then, maybe we wait until, after the earnings. Earnings date NA. Okay, so we don't know. Anyway, in the meantime, like if I were going to chase this, probably I would just buy the shares instead of buying some options. Other things you can do is for a stock like this that's super strong, is you could go out a little, like not to March, but go a little bit further out, not the nearest monthly expiration, but the one after that. And you can look at the options that are like 30% higher. And it looks like this chain doesn't even go very high. So 20 to 30% higher on this would be what? It would be like $10 higher. So like these 35 calls, like if you thought that this was just going to keep right on ripping and not even stop, then maybe a better way to do it than going into a swoosh position is going into maybe these 40 calls from April, which have 47 days to go. So what can happen is, if by the time this thing gets to 40, if it gets to 40 quickly in like 2 weeks time, let's look at that in the simulator. And what I expect is that this call is going to be worth a whole lot more. So here we are. Let's look at it. All right, yeah, so 40% higher. The 40 call is just about at the money. Let's see. Say that happens in 2 weeks' time. Put it around middle March. Yeah, I mean, it's this call will only have doubled. So I mean, that's super expensive. It's maybe better to just go into the shares, because and then you can add calls on pullbacks in the shares. Of course, it could just keep right on running, and by the time you get out here to April 16th, if you're lucky the stock doubled, well then what, maybe you've made 3 or 4 times your money. I mean, it's just these options are so expensive. But anyway, it's a good stock to have on the watch list. Fisker. All right, well, that's about all that I wanted to cover today. So, all right, well, thanks for watching. If you like the show, hit thumbs up. Share the video, retweet it, whatever. Follow me on Twitter @John Tate, JONTAIT. Thanks for watching.